Hey there, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 17th of October, 2025. I'm Mark Gardner. Now, we had regional banks lead the market lower overnight on credit default issues. We spoke about these sorts of things in previous morning pods. Sort of wanting to keep an eye on things overall, but we won't maintain the usual order of these slides. I might just come back to this one. As you can see here, regional banks just getting really hammered. There's some deep red in there. And this is on the back of a couple of the regional banks, Western Alliance and Zions. Zions Bank Corporation is, they've announced some Zions was 50 million, charge off or write off, whatever you want to call it. And then Western Alliance has made some higher concessions for loan write-offs as well. Jamie Dimon mentioned earlier in the week, and it's a great line because they increased credit provisions, even though they were down on their earnings, even though they beat expectations, but they increased their credit provisions. So, when loans go bad, that's the worst thing that can happen to a bank because that's where they make their money. But he came out with a great line, which is absolutely perfect for this situation. When you see one cockroach, there's normally way more cockroaches. And I'd spoken about the First Brands collapse last week that UBS had 30% of. It was billions of dollars. So basically, in this confession season in earnings, there's a few more cockroaches, and who knows where the nest is. So I've always been very concerned around where credit spreads were compared to, so this is something that for people who have watched the podcast on a regular basis, so we were down here at the second or third green bar low at record lows for credit spreads. So for those of you who don't know what credit spreads are, it's the difference between lending money to the US government and lending the money to some crappy junk, company that's a high risk. So the difference between the interest rate you were getting lending money to the government and a high risk company was minimal. Basically, you essentially, it means that you would always want to lend money to the government because you're going to get your money back. That's obviously around about 4% or whatever it is at the moment. But the rates for these junk bonds were more like, what's called US CCC rated, were only 11%. So you're taking on, so 4% guaranteed can never lose your money versus 11%, probably a very good chance that things could go horribly wrong. You would want much higher rates, basically, and that when that spread narrows, that's a sign of very frothy markets. We're at stage 2.1 here, moderate. If we go anywhere, start to go further. So here's the S&P, and they're about a day delay, but you can see there's a correlation between, the credit spread index heading higher and then the S&P drifting lower. And then this is what it's to do with. So this is AAA rated. They've gone from what was it there, about 0.42 to 0.47, right? So 5 bips, 0.05%. US CCC rated has gone from about 11.6 to nearly 12.5 essentially. That means that there's just going to be a lot less money just flowing around in the system, and when those credit spreads widen, money markets freeze up a bit. This is basically the stuff that caused the GFC. I'm not saying that we're going to have the GFC, and so, however, and we all know what that period was like for equities. This is possibly, forget AI, forget the thematics in the stock market. This is what you need to be monitoring essentially until the coast is clear, because if these banks and there are more provisions for bad loans and then some private credit starts to unwind, it won't matter how many chips NVIDIA sells or how much AI, froth there is in the market. This thing will get cooked. So and take it from someone who was a credit spread trader, back in '07. Yeah, it's, markets do bounce back a lot faster these days, but issues around credit take ages for money to free up again, and people get burnt hard. So, because you think about a lot of credit and fixed incomes and private credit's being sold as, it's just a bond. Like, no, you never get. But like, these people have gone into an investment, got say 12 or 13%, for instance, thinking they would guarantee get their money back, and they lose the whole lot. So, and and a lot of these private credit funds are not very transparent at all either, and they essentially package up a whole lot of loans in one package. And to be competitive and stand out from the crowd in the space, they have to put in more higher risk loans to get that yield up. Otherwise, heaven forbid, they get less commission. So, and that's what happened in the GFC, but the banks did it, and they did it with mortgages. So now that, thankfully, that's one reason why I don't think there'll be systemic risk in this, because it's the same crap and the same stupid tactics being done, but it'll be isolated it won't be in the banking system. Well, the banking system will be affected, but it won't be in the banking system. It will be private defaults in private credit funds or whatever, which will, they will let them. They will just let them go. So, it's a lot easier to let a private credit fund default and be shut up shop than it is, the banks. So, a different situation, but it is mortgage-backed securities in a different wrapper. I've said that 100 times, and people essentially look at me and go, yeah, whatever. But but these are the sorts of things like, this may be it. I don't necessarily know. No one does. But I did mention a few weeks ago when I brought up the first brands, is if we start to see more of these, that's something the market can't ignore. And forget the fact that we're in like 20-odd day of a government shutdown. Trump's threatening to sever ties with China. He declared that they're in a trade war with China yesterday. Valuations are at record highs, blah, 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 blah. I mean, the market seems to be able to climb the wall of worry there. But credit default issues, forget the wall of, like, you can't climb that wall of worry. It's that's like, you will just get dragged off that wall and thrown into the dirt. So it is something to be concerned about, and I'm using strong language because I don't want people to. I've been through these things. I've been through black swans, quite a few of them, in fact, since 1996. And when I started in markets, this is something you need to pay attention to. So it's it is of concern, and no matter how strong thematics are, the flow of money and the freedom of flow of money, if the credit system freezes up, that's bad for everyone and everything. So as you can see there, I mean, Nvidia, these guys sort of headed higher, but broadly that is of concern. It's the regional banks. We'll have more regional banks still reporting over the next couple of days. We'll see what skeletons are in the closet. And we kind of go from there, but just we'll keep you updated in the morning pod. Earnings next week, much more interesting as we start to heat up. There's still no economic figures. A bill was tried to be resolution of the shutdown was tried to be passed overnight. It got knocked back. So that means we're probably going to go into. It'll take 5 more days for them to get that sorted out. To even get something to the floor. So Netflix will be a good one. Northrop Grumman, their defense contractor, they'll be interesting. Tesla, SAP maybe. It's big company, but and then Procter and Gamble will be pretty important because you've got the healthcare sector showing signs of some form of recovery, and we'll be really closely watching that one and HCA Healthcare. But I mean, P&G will be very important. Just because if we get some positive results there and we form a bit of a floor in that, that's going to be a great place to be buying. You get cheap defensive exposure, and healthcare will survive a lot better than most sectors in a general market pullback. So it's one of those good opportunities where you get defensive growth at a good price, and you're not having to pay a premium. And they are, and that sector's down 4% this year, or 3%. Whereas, you all know the numbers on how much everything else is up, including gold and things. So yeah, and speaking of which, we've obviously gone through this. Speaking of which, gold, silver up again overnight, new record highs in both. Platinum was up as well. I believe that would have been a new 52-week high, but I didn't check that. But if it's not, it'll be close. Crude came off a little bit because obviously you're worried about the economic cycle. Credit. I mean, apart from the government shutdown, slowing things down and weakening numbers leading into when we were getting economic numbers, the credit system seizing up a little bit. It's not good for, it's very non-cyclical. It's very anti-cyclical in terms of a downturn. It's cyclical in terms of a downturn. So you would probably expect to see copper maybe struggle a little bit potentially as well. Uranium had some steam taken out of it overnight, which was not really unexpected, just because of, and lithium, they've been on an absolute tear, and some heat's been taken out of the market a little bit overnight. The Aussie is generally considered a risk currency, so it won't do particularly well during these periods for whatever reason. Or despite the fact that I think we print far less, about a third of what, or less than what the US does. But we're just saying, because we're quite often the proxy for Asia, and we benefit from cyclical uplift in the economies when there's cyclical downturns, because we're seen as a mining nation. It's generally gets fairly hit. So so overall, I think, look, we were trimming and looking to trim in gold and silver and potentially platinum, and we did do a little bit of trimming earlier this week in some of the gold miners. I now mildly regret that, I've got to say. But we've obviously got a new catalyst, which I didn't necessarily see coming, in terms of the credit spreads as well. Those safe haven assets are going to see more demand and more bid. So you want to be going towards defensive sectors. That's like consumer staples, healthcare. So, and what I describe to our clients as needs, not wants. So things like consumer discretionary, just get rid of them. Like, those sorts of things. If companies can't get credit, well, I mean, and US, I think at the moment, US consumer credit card debt is record highs, and credit starts to seize up. You're not going to see money flowing at the consumer level as well. So, pretty important. You've had essentially, this is the best 3-year rally since 1996. Don't fall into the trap of the FOMO. Be sensible. Look at a couple of your portfolios. Look at stocks in your portfolio. See what has been on a great one, but probably you could take some off and start doing a little bit of trimming. This credit thing may pass, but it may escalate very quickly. And it was a lot slower in 2007 because it had never happened before. This thing, because it's now happened before and people have got a case study from the past, if it unravels, it'll unravel much faster than what it did back in 2007. And obviously, and it was more systemic because it was the banks in 2007. So, do yourself a favour, go watch The Big Short over the weekend or something. There's some great explanations in there. And then just, and just be mindful as well that whole movie was, that took 3 years to play out. So, there's no reason to panic just now, but when we're at elevated levels like this and you've got safe haven demand like gold and silver going through the roof, no matter what the equity markets are doing, and then you've got all of these other issues like government shutdowns and yada, yada, this is kind of this could easily be the straw that breaks the camel's back. So you want to be a little bit cautious, and bank some profits, sit on some cash for a little bit. The importance of that cash is not the yield you're going to get while you're sitting in cash, which is obviously not much. Where the benefit of holding that cash is having liquidity to buy when the market's down and go shopping when the market's on sale. So it's you don't want to be like that. That is priceless. We did it in April. We were 50% cash leading into Liberation Day and 10% gold and silver for our clients. And we bought all through April, and we probably made about 2 or 3 years returns in that period alone. That's what the opportunity is. That's why you sit in cash. You don't sit in cash scared. You sit in cash and have a plan of what you're going to buy when the market goes down, because in the long run, you should always buy the dip. So but if you don't have any cash, you can't do that, and it's all very well and good in hindsight. But save yourself some stress. There was more than enough risk flags for months, but this is probably one that I would say will creep up and really buckle it on top of everything else that's going on. I think today in the Aussie market, you'll probably see gold and silver and platinum stocks up. The banks Macquarie went on a great run. You'll probably see some selling in the banks for sure. But I think we'll hold up a little bit better than what the US did, because our banking system is far more stable. As much as we all hate the Big Four, or we all whinge it as a consumer, that 4 pillars, it makes our banking system one of the most stable in the world. So, and we've got a lot of materials that critical minerals that everyone needs, got a lot of gold. So we should hold up a little bit better overall. And probably, like I said, expect to see some, opportunities maybe like Woolworths potentially, which is downtrodden, or, CSL's bounced a little bit now, but some good solid, stuff in the consumer staples and stuff in the healthcare sector probably would be the only options I'd be considering at the moment. So apologies for the dour way to end the week. But I think too many brokers are focused on, the upside, and don't give the risks out enough, or early enough as well. So just wanted to flag that it's something you should be watching. And we'll probably expand on it a little bit more in Bulls versus Bears with Jonathan and Finn this afternoon. And you can get that on Spotify, YouTube, Apple podcasts, etc. as well. So have a great day and have a great weekend. We'll speak again Monday. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.